Okay, this is our second video about CCA, and in this video, I want to go over the fundamentals of the calculation. We'll do some of the straight line, some of the not as common techniques in the third video, but for this one, I want to just focus on the specific details that are the most common on doing CCA. So we'll go back to my document camera screen. All right. Now, the first slide you see in terms of mechanics, slide 5 in the CCA, talks about assets acquired pre-November 20th, 2018. So, we clearly are not in that time frame at this point, but I do want you to be aware it's possible you would see these rules if you have a non-arm's length acquisition in some situation. So one company sells a fixed asset to another company that is not at arm's length. So there are certain situations where the specific details may be different. The process is the same. The basics of the calculation are the same, but be aware that if you've got an asset that it was originally purchased prior to November 20th, 2018, and you're dealing with something like non-arm's length or something that looks unusual to you, you might want to check it. All right. For assets acquired currently, the process is a pooling situation. So when we say pooling, we don't do tax depreciation. We don't do CCA with individual assets. Unlike accounting, there is a so it's not individual asset by asset. What we do is we take categories, what we call classes of assets, and we group the assets and put all the assets in the group. So all assets of that type go into and we'll see what this does is essentially create an averaging. Part of the reason that we do this is to make things fair, and I'll look at this with you, an ability to pay process that typically, if you're a going concern and you sell one asset, these again are assets you're using in your business by definition. These are your long-lived assets that are used in the business. And what that means is typically if you sell one, you need to replace it. Well, if you sell something at a loss, or sorry, I'm at a gain, and you have to pay tax on the gain, that gives you less cash to replace the asset and so forth. And we'll see how this pooling concept allows us to essentially average the costs over a long life period, even though the assets individually may have a shorter life period. So what we do is we say, let's say you buy an asset that costs, say, $50,000, and let's say it goes in class 8, which is a 20% declining balance class. All right, so we have a beginning balance in the class of 0, and then we're adding 50,000. All right. Now, what we do, the government, I mentioned in the first lecture, has a very commonly has an incentive, or sorry, motive to provide incentives to buy these sorts of assets because they relate to doing business and we want to help the cash flows and so forth and so on. So the government put in a rule that essentially will accelerate the deduction for the use of the fixed assets. And the nature of that acceleration is that in the first year, you basically get 1.5 times your normal CCA. And the way they do that is you then take 1/2 of any net additions to the class. In this case, that would be 25,000. And we'll look at the netting concept in a few minutes. So we take 1/2 the net additions, and that gives us 75,000 total. And then we take CCA of 20% on that 75,000. So I have to do the math here. So that's 15,000 CCA. All right. So then your ending balance in your class would be your beginning balance of 0, your additions of 50, minus the first year CCA of 15. So your ending balance, your UCC, that's undepreciated capital cost, is 35,000. All right. Then next year, in year 2, I take 20% of the 35,000, and that's 7,000 CCA. So now my UCC is, don't ask me to do math without a calculator, 28,000 and so forth. Okay. So that's your process. So let's say now we have a sale of some of these assets. So I've got a UCC of 28,000. The way I do a sale, I want to keep this available to us. So I have this beginning balance. We'll just put it out here so you can see it. We have track of it of 0. We added 50,000. And we had year 1 CCA of 15. So we had the UCC of 35. Year 2 CCA of 7. So we've got a UCC now of 28. And let's say we sell out of this 50,000, that was more than one asset, say there were a number of things in that grouping. So let's say we sell one that had an original cost of 6,000 and we sell it for 2,000. Right, so you'll notice we're actually selling at a loss. There is a loss here, a reduced available usefulness, all right, of 4. Okay, now again, we've got this averaging process. So what happens is I take the lesser of the original cost of 6. The proceeds of disposition, that's the selling price, is always called proceeds of disposition. 2, and I subtract the lesser of. All right, so that gives me a UCC of 26,000. Okay, so because I've still got assets in the class, all right, and the class is positive, then I just keep taking normal CCA. So year 3 CCA would be 20% of the 26,000. Or 5,200. Now what's happening here is that 4,000 decrease in usefulness, instead of being deducted in the year of sale, it's being deducted through CCA, because notice that 4,000 is still sitting in the UCC balance. I only took out 2. I didn't take out all 6. All right, so 4,000, 6 minus 2, is still in the UCC. So what I'm doing is taking CCA, and that's what I mean when I say we're averaging. We're spreading that out over the life of the asset. Now, what I want to do is make it a less realistic, a little simpler, so you can see exactly how this might work if we buy and sell the entire asset. So let's just have a car, say, and that's going to be class 10, which is a 30% class. So let's say again, we start with 0. We won't have any balance to start with, and we'll buy a car for 25,000. All right, and then we have the 1/2 net additions versus disposals, and I'll show you an example of a disposition and an addition in the year in a few minutes. So 1/2 net is 12,500. So we have a UCC of 37,500. CCA at 30% is 11,250. So we have our UCC of 0, our addition of 25,000, and our CCA year 1, 11,250. So we have a UCC of 13,750. Year 2 CCA, again 30, is 4,125, I hope. And so our UCC now is 96.25. So let's sell the car now. And the first thing we'll do is sell for greater than original cost. So we're going to sell the car. We've got that UCC of 96.25. Let's sell the car for 28,000. So once again, on a sale, what I do is I subtract the lesser of the original cost, which was 25,000, and the proceeds of disposition, which is 28,000. So the lesser of those two is 25. So I subtract that. So I have a negative balance of 15,375 and no assets. All right, so the account goes negative. Now, as it happens, if the account goes negative, it doesn't matter if there's any assets. So once the account goes negative, what is this telling us? All right, remember I said this is not valuation. So what we're saying is I had this 25,000 cost that I incurred for something I expect to use. So this represents usefulness. I had 25,000 of expected usefulness that I thought I would have. So what does the CCA represent? That represents the amount, the estimate of the amount that was used up. So if I look at that, it's a total of 11,250 plus 4125. Which better equal 15,375 or we have a problem. So notice the estimated amount that I used up is 15,375, which is the negative amount in the class. So what is this telling us? Well, if we look at the selling price versus the original cost, how much did it cost us to use it? Look at it. Well, if I sell it for more than I paid for it, it didn't cost me anything to use it. It costs nothing to use it. So what would be the appropriate deduction representing the cost to use it? Clearly, the appropriate deduction is also 0. Right? Okay, so what we should be doing then is basically adjusting our CCA. We need to adjust the CCA to reflect that we've taken $15,375 of deductions for costs we didn't incur. It cost nothing to use that machine, to use that car. Sorry. All right. Well, the way we do that is anytime the account goes negative, we add the negative to income. So if a UCC class has a negative balance, and that can only happen if you sell something. It can't happen without a sale. Doesn't matter if there's assets in the class. You add the negative balance to income. It's called recapture. So I have that UCC of 9625. I subtracted the 25,000. It went negative by 15,375. What I do is take that into income, called recapture, and the UCC is now 0. Now there may be assets in there. Again, this averaging thing, but if there are assets in there, there's no CCA because it's been fully deducted. In this case, of course, we had only one asset, so we sold the only asset in the class. And that simply reflects that we've incurred a cost of 0 or less than we deducted. So any negative balance is a deduction for a cost that wasn't incurred. So we add it back. You don't have to go back to the original year you took the deduction. In the year of the sale, you add that back. All right. Now we do want to notice, since I sold for greater than original cost, I have 28,000 proceeds of disposition and 25,000 cost. I also made money holding the asset, right? So there's a holding money making here thing, which is a capital gain of 3,000. So what we're saying here is not only did it cost nothing to use the asset, I actually made money. So the amount that you've got up to the CCA is business income. Recapture is business income because it was a business deduction. CCA was a deduction in computing business income. Recapture is an addition in computing business income. The amount in excess of original cost is the capital gain. It's the amount from holding the asset, not using it, or negative not using it, I guess you could say. Now it goes the other way when I sell an asset at a loss. So let's take that same car, go back to our car where we had the UCC of 0 and we added the car of 25,000 and then the 1/2 net 12,500. We had our 37,500, our CCA at 30%, the 11,250. So we've got our UCC 0 plus 25, CCA year 1, 11,250, UCC 13,750, CCA year 2, 41.25. So our UCC 96.25. So now let's sell for less than. cost. Oops, sorry. I do that all the time. I get this out of camera range, right? So let's sell it for 5,000. So I have this UCC balance of 96.25, and I'm going to sell, again, subtract the lesser of original cost of 25,000 or the proceeds of disposition of 5. The lesser of is 5. So now I have a UCC balance of 46.25, but no assets. In this case, it does matter if you have assets in the class. So if you've got any assets in the class, you just take CCA like we did in our first example with the 50,000 of equipment in class 8. In this case, because I've got no assets, what is this telling me? All right. Well, what this is telling me now is since I sold the car for 5, I paid 25,000 was the original cost. 5,000 is what I get on the sale proceeds. So it cost me 20,000 to use the asset. Well, how much have I deducted? I've deducted 11,250 plus 41.25 for 15,375. Well, that's less than the cost. It's less by, I hope, 46.25. So you take the 20,000 minus the 15,375, and it has to be because it's just reversing the math, right? Oops. Okay, so it cost me 46.25 higher than I've deducted. Okay, so again, CCA, depreciation, all those things are cost allocations. Well, I didn't allocate enough cost. It cost me more than I've actually allocated, so I fix it. The 46.25 is a terminal loss. So I deduct the loss. So the way that looks is I have the UCC of 96.25. I subtract the proceeds of disposition. Again, we did this calculation right here, where we subtract the lesser of the original cost or proceeds. I have a UCC balance of 46.25, no assets. So that is a terminal loss. I guess it should write it out fully. Terminal loss. All right. That is deducted from business income. All right. I didn't deduct enough. It cost me 46.25 more to use the asset than I've deducted. So now I deduct the additional. Now I want you to notice, so our conditions are that one, the UCC balance is negative. No, sorry, positive. I have a positive UCC balance, and 2, no assets in the class. And that results in a terminal loss. Now I want you to notice there can't be a capital loss on this. You can't go negative, all right? In order to have a capital loss, the account would have to go negative. That's not economically possible. So the most you can have is that terminal loss. There can never be a capital loss on a fixed asset. Losses on fixed assets represent cost allocation adjustments. There's nothing else there. Only if you sell for greater than original cost, in which case that's a gain, do you have a capital issue. Now, the final thing I want to demonstrate is when you have both additions and deductions, just so you can see what we're saying when we say half net. So if we have a UCC class, again, it doesn't matter. Let's do class 8 again. Let's assume it had a beginning balance because it really doesn't matter. But in order to sell something, I have to have something there. So let's say I've got a beginning balance of 85,000. And sometimes students ask me, where are these numbers coming from? They're coming from my head. As I sit here, I'm just talking. I haven't designed this in advance and there's nothing real about it. You can do this yourselves. The best way to study, make up problems, make up numbers. If you can't figure out the answer after you've done that, contact me. It's not uncommon that the reason you can't solve the problem is because you made up numbers that don't work. And it helps to see that, to make these mistakes. It's actually very helpful to you to have those mistakes and have to sort them out. And I can help you sort them out. So you can always show me if you make up some numbers and they don't seem to work. So let's assume we've got that beginning UCC balance. And in the year, we buy additional Class 8 assets. Make sure I'm still on the screen here. Let's say for a cost of 24,000. And we sell a Class 8 asset. And this is office furniture and fixtures, things of that nature. And let's say the original cost of the asset was 16,000. And the proceeds of disposition, it's not likely to be a gain, is say, make sure I don't do this too screwed up, 9,000. No, let's do 4,000. All right. So what I do here is for the additions, I say, okay, we're going to add 24,000. That's my new asset. And our sale, we subtract, as always, the lesser of the original cost of 16 and the proceeds of disposition of 4. The lesser of those is 4. So I subtract 4. So that means my addition is net 20. So this is when we say 1/2 net. So now 1/2 net is 10. 1/2 net would have been 24. But because of the subtraction, 1/2 net is only 10. All right, so my CCA for the year then would be the 85,000 plus 20,000 plus 10,000. So that's 115,000. CCA at 20%, class 8 is a 20% class. So that's 23,000. All right, so my ending balance for the going into the next year, I have that class 8. I had the beginning balance of 85, the net additions of 20, and the CCA of 23. So my UCC is, I have to add it. Always check my math, is 82,000. So that's the UCC balance. So that's your 1/2 net that they're talking about, because it's very common, of course, to have additions and sales in the same, additions and sales in the same year. That's quite common. Now we want to make sure you're clear that a terminal loss, whoops, let's just do another page, couple of odds and ends here. The terminal loss, unlike CCA, the terminal loss is not optional. Neither is recapture, for that matter. It is not available to employees. You'll recall I said that employees in certain circumstances can take CCA on cars, aircraft, but they are not allowed to take CCA. Just the way the law is written, again, if it's not referenced in Section 8, which the terminal loss rules are not, they're not available as deductions to employees. And again, remember, I'm going to say this again. I've said it over and over again. These are all cost allocations. So let's look. What does UCC, which is the equivalent of accounting net book value, what does it represent? It represents remaining usefulness. If you're explaining to someone looking at a balance sheet what the net book value of an asset is, it's remaining usefulness. It is not quote value. I hate the fact they actually use that word. Original cost of an asset is expected usefulness. I mean, if you think about the decision, back to decisions. If you think about the decision to buy a fixed asset, how is that decision made? This goes back into your capital budgeting, things of that nature that you've studied at some point. You've looked at these things. The decision to buy a fixed asset is a function of expected cash flows from using the asset. You're not going to buy an asset if the expected present value is negative. Right? So this is usefulness. It represents usefulness, the original expected usefulness. So what does CCA or accounting depreciation represents? It represents the estimated amount used up. Right? And as a result, then UCC or net book value is the estimate of remaining usefulness. So, you know, I keep coming back to this partially because I see it misstated so often. And it's important that you realize that there's a difference between an asset that you've purchased to sell and an asset you've purchased to use. And in terms of relevant information, in terms of understanding what the numbers represent, it's not value. And if you think of it as value, you're not going to understand the numbers. So it's so important you think in terms of usefulness. If I ask you these questions, make sure you talk about usefulness. Don't talk about value. Again, I'm saying that. Now, some odds and ends, like you'll notice I've got this slide rule. The half year rule is something for pre-November 2018. Again, you may see it if you've got assets or a situation that involves that. Available for use, there are occasionally issues about when it actually is available, because that's when you start taking CCA. A taxation year less than 12 months. I want you to notice in the examples that I did so far, I have not worried about when during the year I bought the asset, because it doesn't matter. Right. Originally, that's why the half year rule was there, was to say, okay, we're just going to average out when you bought the asset. Currently, under our current system, it doesn't matter when you bought it. It does matter if you've got a taxation year under 12 months. So what you would do with a taxation year under 12 months is you would take that situation where, so if I bought the asset, 50,000, it's in class 8, that's 20%, but I bought it in August, say August 1st. Or sorry, I bought it, doesn't matter when I bought it. My company, sorry, it's the taxation year. Company tax year is December 31st, but the company started this year, August 1st. All right. So what I do for a year less than 12 months, I take the 50,000, and of course I have to do the half net, so that's 25. So I've got 75,000. So I take the 75,000 times the 20%. So that's our CCA of 15. You can look back at the other examples where you see that I did that. Now what I do though, is I do have to prorate for the partial year. All right, so August is 31, September 30, October 31, November 30, and December 31. So 1, 2, 3, 4, 5 times 30 plus 1, 2, 3. So that can't be, is that right? Yeah, 153 days divided by 365 times, if I did that right, August, September, October, November, December. Yeah, okay, so I prorate that 15,000 to, it'll be 6,288. All right, so for a partial year, you do have to do a prorate. Otherwise, you don't care when the asset was purchased. So it doesn't matter when the asset was purchased. Like this asset might have been actually purchased on December 1st. Doesn't matter. It's the fact that the company does not have a full year that we're concerned with there. Okay, so that's the basics of our calculation. You have problems where you'll do this, and so you can always double check it and check with me if you have questions. And then our final lecture, I'm going to talk about just some of the odds and ends, the straight line classes, and a few just various details that we want to worry about.